Well, welcome everyone to our live stream. And so it's the usual procedure. You can ask us as many questions as you like that you can fit into 1 hour. And Teddy and I will be fielding the questions. And my partner Laura will be making sure that I don't get the screen sharing wrong. So that's the respective roles. And of course, members people who support us on YouTube get pushed to the front of the queue for answering the questions. We can tell who you are because you've got a little crown next to your name. And if you do a super chat also, you'll be pushed to the front of the queue. And of course, it supports us, so we'd appreciate that if you do. So let me just start off by saying that this week we've launched our podcast, and it's been very popular so far. So, thank you if you have listened to it. And it helps us a lot if you go to Apple iTunes, so Apple Podcasts, and find Many Happy Returns is the name of the podcast. And if you vote for us, then particularly if you give us a good rating, it helps the podcast. But I think you'll find the first installment pretty interesting. It's about inflation. And I think what's very different about a podcast is that you can really let your hair down and not kind of have the formality of a video where I'm trying to present an idea and I'm quite serious. I laugh quite a lot, and the person I'm presenting it with, Michael Pugh, I think we've got quite a good vibe going, and we just laugh all the time. It's really good fun recording it with him, and also kind of developing the content that we're going to discuss. So I think that comes across in the recording. And it's a fairly dry subject, inflation. So I think it makes it more palatable if you add a bit of humour. Anyway, so I don't know if we managed to make inflation slightly less tedious, but many people seem to like the episode. So do have a listen. It's called Many Happy Returns, and you'll find it on your distributor of podcasts, whatever that might be. So let me just quickly start off also by just taking a quick look at what's been happening in markets over the past couple of weeks. So I think it's been fairly shocking for some people that we have had a sell-off in the Nasdaq and also the S&P and many other indices across the world. I think, some people are saying that this is the start of a huge sell-off, which is possible. You never really know. People claim they say they know, but they don't. So all you can really do is, I think, just stay the game. And if prices do come down, just see that as a buying opportunity. It's the usual conundrum for people who invest, right? You never really know whether a 10% sell-off is about to become a 40% sell-off or much more likely snap back to where it was before. And people often get trapped into selling when there's a 10% fall, only to find that markets do snap back, which is the most likely outcome. So obviously what's different this time around is that we're going to see 3 Fed rate hikes during the course of 2022. That's spooked some people. But personally, I think the sign that the Fed is hiking is because the economy is strong, right? So not terribly strong, but strong enough in terms of the employment numbers that we've seen, which have been pretty rapid in getting back to where they were pre-pandemic. Largely because of the huge amount of stimulus that we've had. So I think people learned their lesson from the 2008, 2009 crisis in that they very much pulled out all the stops in order to get the economy back on track in many developed countries and many EM countries as well. So I think that's been a good thing. But there's always the worry about inflation becoming too ingrained. So anyway, listen to that podcast episode. We talk about inflation a lot there and dive into how long it might take to recover. So let me launch into the questions. And we've already got a question from one of our supporters, from Hisham Daoudi, who says, do you know about C20? It's a tokenized cryptocurrency fund. It has a 0.5% annual fee, which is quite good for a crypto fund. Would this be a good idea to have a diverse exposure to the crypto market? Would you consider it? In fact, I did consider it, Hisham. I was quite impressed by it because instead of just buying one crypto, you buy a diversified basket, and they have a certain methodology where they work out, what are the best and largest cryptocurrencies in order to be part of the fund. Now, for me, the problem was buying it, because for the crypto exchanges which I use, which is Coinbase and Kraken, they didn't sell it, so I couldn't buy it, unfortunately. There are obviously exchanges out there where you can, but unfortunately not the ones I was using. So I think it's a good idea. I think you can always create your own basket, but then you have to rebalance, of course, and that's a bit of a pain. But, if you have your own basket, then, that's another way of approaching it. Or you could look at the weights of C20, maybe just take the largest 5, 10, and reproduce it yourself, just to see how the returns would look. But I certainly think that diversification is a good idea, whether it's cryptocurrency, whether it's equity, whatever the type of investment you do, because it's just admitting that you could be wrong. You think that a certain cryptocurrency, Algorand, Ripple, Ether, is going to rally hugely, but what if you're wrong? So by admitting that possibility, by being humble, effectively being humble for a portfolio means diversification. So you spread your bets, and you won't necessarily shoot the lights out, but you will have smaller drawdowns, and there's a greater chance of catching one of the currencies which does rally quite a bit potentially. So yeah, I like it. The fee's fairly low. It's simple, but I just wish it was traded on the exchanges I use. So I have come across it, Hisham, and I do like it. Yeah. Right. Next question is not from a member, not from a supporter rather, on YouTube. You can become a supporter on YouTube. Just go to the Join Us button underneath the video, and then you can become one of our supporters on YouTube, and then we'll push your question to the front. But failing that, I'm just going to work through the statements and the questions in the chat. So the first one is from RCP, who says, "Hi Ramin, great podcast show this week. Thank you. What are your thoughts on investing in China this year? Given the recent rate cuts, boom times ahead, India had a great 2022. Could we see this continue?" Interesting tweet I saw today, which I'm just about to share with you, which gives me the possibility of not forgetting. But I'm sure Laura will shout down the stairs if I do. Yeah, here we go. So let me just share this with you. So this is, so this is a tweet about the credit impulse in China. Let me just zoom in on the graph so you can see this. So what this shows you is how much credit is available to households, to companies in China. Usually what they use is total social financing, which isn't just bank lending, it's also corporate lending. It could be any form of credit, so it could be wealth management products. It's a very broad definition of credit, but think of it broadly as how easy it is to borrow money in China and how much money is being lent. Now, when that starts to increase, that's called a positive credit impulse. So let's look at these waves of credit impulse in the past. If you look at the dark blue line, that's the credit impulse. When it's falling, there's a contraction in the amount of total social financing. When it's growing, that's a positive credit impulse, and that's a growth in total social financing. And generally, risky assets in China will rally when the credit impulse is positive. And of course, it's not just China which is affected, it's everything, because here they've shown the global manufacturing PMI, which is in grey, and you can see that's fairly closely related with the credit impulse. So you can think of this as a kind of driving force behind the global economy. So let me switch back to me, so I don't forget. So this credit impulse then is a really important driver now of global risky assets. So when that goes positive, if you're a country like Australia, which is strongly linked to China via the commodities that they export to China, then this positive credit impulse is really good news. So for the Aussie dollar, it's probably good. For the Australian GDP, it's good. And then for any country which is linked to China, also good news. And we've seen for the global manufacturing PMI, also good news. So I think the fact that that's kind of turned the corner is probably a good thing. Is it delaying the popping of the Chinese credit bubble? Yes. Is that necessarily a bad thing? Not in the short term, not in the medium term probably, but eventually it's going to be an issue. So we'll just see how well China gets to pop that bubble and deflate the bubble, hopefully. But at the moment, that increase in the corporate, in the credit impulse, I think is a positive story. So going back to your question, which I'm about to do, just so I don't get that wrong. Is it boom times for China? Well, it's certainly cheap for many stocks in China. And I know personally, I did a couple of power hours with people who've gone heavily into Chinese stock because they see it as fundamentally sound and they see valuations very low. They certainly are low relative to where they were, say, just 6 months ago for many stocks, particularly the tech type stocks. So, that could be an opportunity. If you're brave, then I think, it could be a good contrarian play. But personally, I'm not brave. So, I've already got exposure via KWeb. I'm still bleeding with my KWeb exposure. But if you're new to the trade or you closed out your trade when you were at the top, then, maybe this is a good entry point. Am I incredibly bullish about China? Probably not, because if the US pulls back, I think that could be bad for China, certainly in the near term. So, I think during this kind of US wobbly period, I'd be a little bit cautious about getting EM exposure via China. But, if that does start to stabilize, then yeah, I think that's an opportunity. But let's see what happens with the rate hikes first, because, the first rate hike's always a bit of a scary thing for markets. It has to absorb that, and then we'll have to see what the Fed narrative is about increasing interest rates. If they shock markets by hiking really faster than expected, that could be a whole trigger for a nasty event in equity markets. But, the central case, US wobble flattens out. Markets are okay. Earnings seasons are okay for the first 2 quarters of 2022. And, equity markets, which are cheaper, like China, would potentially rally with that kind of backdrop. So back to your questions. And the next one is from Belinda. Hi, Ramin. You always say we shouldn't sell when markets go down. That would be an interesting video. Buy the dip. In fact, that's my video for this Saturday. So that's going to be relevant to you, Belinda, I think. However, is it not the time to at least trim our equity positions, as the Fed may hurt us badly later on this year? Well, like I said, Belinda, the Fed is raising interest rates because the employment market is recovering. If it was the case that inflation was high and employment data were lousy, the Fed wouldn't hike. If it was still the case that the US economy was in a terrible state, they wouldn't be raising interest rates. So that's the way you've got to see it, which is that they are confident that they can hike without destroying the economy and the economic growth that we've seen after the pandemic. So, I think that the US economy can certainly weather 3 interest rate hikes because the Fed does. And they probably know more about the health of the US economy than any other actor out there. So, yeah, I think that there's not going to be a huge shock if the central case pans out, which is 3 interest rate hikes, no shocks from the Fed, and reasonable earnings growth for the first half of 2022. So would I be trimming my equity allocation? Well, in fact, I'm still doing the opposite. I'm still building up my equity allocation because I'm still drip feeding into the market. All that will happen is if markets do sell off, I'll accelerate my purchase of equity. So instead of drip feeding to 80% equity over the course of 2 years, it'll just be a few months, depending on how bad the sell-off is, of course, and where valuations are. So, I'm not quite negative enough to say, cut your equity exposure. That's never a good idea, because most of the time markets just shrug off bad news. That's certainly been the case over the last decade. But would the Fed carry on hiking if markets were tanking? Probably not. I suspect that they would step back if there was some sign that inflation was actually not staying very high. So, yeah, I think the markets actually can weather 3 interest rate hikes without a big sell-off. So I wouldn't be cutting my equity allocation. But do have a look at that Buy the Dip video. I think you'll find the results surprising and interesting. Steve Johnson, let me just check for members. Yes, we have a super chat from Midnight Sun. Thank you, Midnight Sun, who says, guess who has 2 thumbs and bought Activision? Okay, what will happen to my stock when Microsoft takes over? Will I own Microsoft? Okay. Well, if Activision does get taken over, then as a shareholder, you will, I guess, it depends on how the merger happens, but you could end up owning a bit of Microsoft, and that's the most likely outcome. So, yeah, that'll be what happens. Usually what happens is the shareholders who exist get notified of the takeover, and if it's a kind of scrip exchange rather than a cash exchange, you'll have the choice to buy some Microsoft stock, I think, at a reduced rate. So it really depends on how they structure the deal. If you're a Microsoft shareholder, you might have a choice to buy Activision and vice versa. Depends how they structure it. But either way, if there isn't an Activision around, you're going to end up owning Microsoft at the end of the day. So, look, it's not going to be the people who actually make money out of these deals. Usually, firstly, the management of the company, sometimes the shareholders, if there's a really competitive bid for the small company that's being bought, then you can make a big profit. But merger arbitrage, which is when you buy potential takeover targets with the understanding that the price is going to go up, then you can certainly make money that way. Hedge funds do merger arbitrage all the time. But there's always the risk that the deal falls through and then the price falls again. So it's certainly not a riskless trade. But from the point of view of an Activision shareholder, then, yeah, I wouldn't worry. All that'll happen is you'll end up owning some Microsoft, probably, if the deal goes through. But you won't be hurt by the transaction unless it destroys value for Microsoft. And of course, it depends on the price they're willing to pay for Activision. Next question is from Steve Johnson again. Bond yields go up when investors sell bonds, which can hurt risky assets. Does it mean, though, that investors will have more cash and will probably deploy it in risky assets later on, lifting their price? Well, it's not necessarily going to be held in cash. So when people sell bonds, it doesn't necessarily mean they're going to hold it in cash forever. Usually they'll buy something with it. They'll reallocate it to something else in their portfolio. So like you say, usually that would be good news for risky assets. But usually in a big equity market sell-off, then that's when I'd be selling my bonds and buying equity. But is it necessarily good news when yields go up that that people are selling bonds and that's going to push up the equity prices? I'm not convinced that's true. No, I don't think that's the case. I think what's much more important is risk appetite. That's the biggest driver of equity prices. And when people are scared, it actually is going to push down bond yields and push up equity. It's going to push down equity prices and push up bond yields. So, I don't think the causality works that way. The primary driver is risk appetite, and then risky assets If someone pulls back their risk appetite, equities fall and bonds rally and yields fall. But I don't think the causality would work the other way. No. Jay says, if we buy the spike, i.e. now when stocks are so expensive after the pandemania, won't we get a hit once stocks come back to sensible levels, either sooner or later? Well, of course, that's exactly what we've seen. What we've seen is that the most egregiously overpriced parts of the market, which is small cap growth in the US, we've seen the prices there fall very sharply, whereas things like value have actually rallied a bit. So I think we've already seen a big sell-off in the most expensive stocks in the US, a very significant sell-off. Unfortunately, Cathie Woods had bought lots of those stocks because she wasn't a price-sensitive buyer. And those kind of disruption stocks are the ones which have fallen a lot. Profitless tech is another one, spec tech some people call it. So I wouldn't be too. I'm not convinced that sell-off has finished either, because valuations are still pretty high for small cap growth, as I said in a recent video. So yeah, I think people have already many people have already had a hit. If you don't buy broad indices, which I do, then you could have got quite badly caught in that downdraft with that particular tilt, which is small cap growth. So yeah, that's always the risk when you have a huge rally in a particular sector, in a particular asset type, cryptocurrency, small cap growth. Then when a pullback comes, then if you don't get out in time, that's always the risk that you get burnt, and many people have. In fact, many people I speak to in Power Hours are the ones who have been burnt. And then we're talking about diversification, but of course by then it's too late. I guess not too late, but too late for them not to have made a loss. Next question. Let's just check members. No. Okay. Anna says, I should say like, and please do like this stream, and also subscribe to our channel, because then you won't miss our content. And the next question is from Anna, who says, you mentioned the cost of carry in the context of working out the price of futures. I think that was last time. Yeah. What is the cost of carry for Bitcoin specifically? Thank you. Well, so let's imagine that I'm going to deliver Bitcoin to you in 3 months' time or in 1 month's time. How would I do that? Well, for the case of Bitcoin, it is a storable asset, just like equity. So I could buy Bitcoin today. I'd fund it via a bank funding, which is very cheap. So currently interest rates are very low. So the cost of carry for the funding is very small. And then you don't get any cash flows for holding the Bitcoin, unless you maybe lend out the Bitcoin. But I suspect they wouldn't do that. So then, the cost of carry would just be the cost of funding for Bitcoin. So that would be the difference between the future and the spot price. Unfortunately for Bitcoin, there's also a kind of liquidity difference, which causes potentially a gap between the futures price and the spot price. But if you were going to deliver something like cryptocurrency, if it was a very liquid market, then yeah, I think the only difference between spot and future price would be the funding cost. So the next question is from Antonio. Oh, someone asked how old Teddy is. He's 4. And Laura answered that one. There we go. Yes, we're talking about you. Have a treat. There you go. You can hear him crunching in a second. Do you think uranium would be a good investment? Well, remember that uranium has already rallied a lot. So let's have a quick look at one of those uranium funds. Yeah. Actually, let's look at uranium futures, because that could be interesting. Yeah. So I'll share my screen. So let's have a look at uranium futures. So this is the uranium futures price. Let's have a look at it, just clean it up. So this is over a 2-year period, and you can see that it's rallied a lot. So how much is that? That's a 36% rally. And if we look at one of those uranium funds, you'd also see that they've rallied very hard. But you can see it kind of peaked in October of last year. And since then, it's been oscillating, but not really falling much. Currently, the price is something like $47, I think, per metric ton. So is now a great time to buy it? Well, I think that uranium is still, interesting for many investors because we are talking about clean energy. And many people now think, it seems to me, that if you have to move to green energy, then even though uranium's not renewable because you have to mine it and there's a finite resource of uranium, it's not renewable as an energy source. It has a finite amount of uranium in the crust of the earth, which you have to dig out. It is clean because it doesn't generate CO2. And nuclear waste is fairly, well, if not trivial or cheap to dispose of, it is disposable in a fairly well-established way. Unfortunately, it remains radioactive for a long period of time, but there are solutions for that, which is to bury it very deep in places where it's made of granite and it doesn't decay very easily and it doesn't have groundwater going through it. So a lot of these problems are solved in terms of getting rid of the waste, and in terms of the waste generated, it's fairly limited. So if we do want something carbon neutral to essentially see us through this transition period, nuclear is a pretty good option. But it looks like renewables are now becoming much cheaper. So there's a real question of how long we're going to have to use this kind of stopgap measure. But I'm not convinced that it's going to stay at a very high price for a long period of time. That was a very popular trade, which now seems to be fading a bit. So I'm not convinced. I mean, I certainly wouldn't pile into uranium at this point. I think it's now probably too late. But it doesn't look like it's crashing, certainly. Right, so the next question is from BMBM365, who says, do you think one day the UK will be seen like Japan used to be, like a safe, well-regulated, innovative stock exchange where US investors park their money? Well, in a sense, the UK is a safe, well-regulated, innovative stock exchange. Maybe not innovative. I think that's one word I wouldn't use to describe it. Because, the stock composition for the UK is just not very... It's pretty much stuck in the 19th century. It's got a lot of banks, a lot of miners, almost no tech. We are trying to change it, and it would be great to see more innovation in UK indices. But there's a very strong tilt to income from UK stocks. And of course, if you're a growth stock, let's say a new company that's doing well, what you want to do is take those profits that you're generating and plow them back into the business so you can grow. But if you've got a high dividend income culture, then your shareholders will be milking you for that profit, which you then can't reinvest. So that's not a good environment for growth stocks. Also, venture capital in the UK relative to somewhere like the US is much harder to come by. In fact, I was talking to a client today about this, actually an Australian client, who said that when he moved to the US, one of his friends moved to the US, it was much easier to get capital. It was some kind of medical innovation company. People were throwing money at his company, whereas in Australia, he'd had real trouble getting funding. And I think the UK is similar. I think we're much more cautious when it comes to funding innovation. So all of those things are true. The law's good. It's well regulated. I think that's true. Reasonably well regulated. But is it safe? Yes, kind of. But is it innovative? No. And I think that's the kind of critical piece of the puzzle for the UK. How can we move away from being a high dividend, low growth market to being a higher growth, maybe not low dividend, but lower dividend investment environment? I think that would be a good thing for the UK to do now. But how you'd achieve that is very difficult, to change the whole corporate culture and also the investment culture away from demanding dividends to promoting growth and the higher risk that comes with that, unfortunately. There's no sign of that happening yet, and it's not something which will happen quickly. So do I hope it happens? Yes. Is it innovative now? No. But I'd like it to be. Next question. Ned Flanders. Lovely to see you again, Ned. Very memorable name. Oh, we've got some questions from members, from Gary, who's a long-time supporter. Thank you, Gary. Who says, remember, if you want to get pushed to the front of the queue, either a super chat or support us on YouTube, just click on that join button. Gary says, what about FAANG stocks now? They're making profits, investing heavily in their future growth. US and the world economy is growing. Even a 4% yield of 10-year treasury is not historically high. All of that's true. All of that's true. And in fact, Gary, I was just looking today at the percentage of profits in the S&P 500, which is generated by the FAANG stocks. So that's Facebook, Apple, Alphabet, Microsoft, and yeah, I think that's it. And if you look at that, it's about 15% of the revenue, 15% of the profit of the S&P comes from that tiny group of companies. So these are very profitable companies. Companies like Amazon are just like cash generating juggernauts. It's just like a cash generating engine. And a lot of the profits come from those companies. So you're right. I think they are very good at generating cash. But there is a real question for some of these companies like Apple. Has it saturated its market? It's already spread to emerging markets. So the question is, how many more gadgets can they come up with which can't be copied by competitors, where people are willing to pay such a huge premium for something which effectively you could get somewhere else? And that's the problem. Where's the growth going to come from 5 years from now? And if they have saturated the market, then that's a real problem, unless they come up with a new innovation, which of course is very difficult. So, it's going to be a hard push for them now. Plus there's pushback from the regulatory side, because they are in some senses a monopoly, companies like Google, Microsoft. So, there is that kind of pushback now. So yeah, great cash generators. It's not like the dot-com era where almost all of the new tech companies were generating a loss. Only a few of the companies, the disruptive ones, spec tech, is making a loss. And of course, those are the companies which have sold off first. And the companies like Microsoft have sold off much less. But we are starting to see even those large cap growth companies start to sell off now. So, the question is this going to spread into risk appetite more broadly? Because the broad valuations now for the US equity market is still very high compared to history. So that is still a worry. And that support from fundamentals is just not there. So when risk appetite fades, all that's holding it up is risk appetite and earnings multiple expansion. If the profits aren't rising to meet the very high valuations quickly enough, then there is no kind of lower level which is supporting equity. But as I say, for the first two earnings seasons, we're forecasting about 20% growth for earnings. So that's still pretty strong. By historic standards, very strong. So I'm not too worried at the moment. So that's why I don't think there's going to be a huge sell-off. But, we'll just have to see how the market accepts 7% inflation, which probably won't come down to 4% for at least 6 months by my calculations. And so that's going to be a tough uphill struggle for many companies where margins are being eroded. So, maybe analysts haven't factored those margin decreases into their calculations of forecast earnings. And if we do see the earnings disappoint, then that could be another trigger for another leg down. We'll just have to see what happens to those earnings seasons. And of course, now we're just seeing the earnings season for the end of 2021. We're not going to see Q1 2022 until 3 months from now. But the forecast for the moment, my central case is that it'll be okay. Next question is from Arsenio Cornelio Penesi. Nice to see you, Arsenio, who says, some people claim that they make a living with day trading. Do you think there is at least a part of truth? Have you met day traders in your career in investment banking? Well, remember the investment banks trade in a different way to people who speculate, right? They're not speculators. The way they make money is via bid offer spread. So at the end of the day, someone at an investment bank trading desk ends the market flat. They don't have a directional position up or down. They just make money on the bid offer spread, which is a very low risk business. If you're a speculator, like a day trader who's sitting at home, trading Eurodollar futures or something, that's very different. And there's a reason why 70% or 80% of those people lose money. But that does mean that out of that, 30% or 20% of people will make money. So if we look at one of those, let me see if I can find an example of that. So let's see if we can find a spread betting company. Here we go. You can see this. So let me just zoom in on that. Oh, look, there's a big warning at the top of the screen. So this is a UK spread betting company. So you can be a day trader here. 68% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Now, they didn't put that warning there by choice. The European regulator, ESMA, forced them to do it. And so the odds of actually entering that market and doing it profitably are pretty low. And I certainly wouldn't recommend it. I do speak to many people who used to be day traders who lost money and now want to invest in a diversified portfolio. But look, I'm not the person they'd speak to if they wanted to learn about day trading. People usually come to me once they've got burnt in day trading and they want to do something diversified and safer with a higher probability of success, but with a lower return when a success happens. So I think that's the way to win. It's not to kind of shoot the lights out. It's to stay in the game for a long time, earn pretty good returns for that long period of time. And that's how you win. Because the fact is that the market makers will take you out most of the time. They'll make money either way. And they want you to trade as much as possible because every trade you do probably nets them a profit. So of course there are these sites that tell you you can day trade profitably, but I have not spoken to anyone who can do it profitably. Not a single person. And, if they're going to be boasting about it, you've got to question yourself, if somebody loses money day trading, they're not going to boast about it. You only hear about the people who say they've been successful, who are probably trying to sell courses in day trading, and then you've got to ask yourself, are they really that profitable? Would they be selling courses in day trading if they were that profitable? Are they just doing it out of the kindness of their heart? I'm cynical and old, obviously, but I just question whether people can make money that way. And I've certainly not spoken to anyone who can. Obviously, the investment banks make huge amounts of profit because they're market makers. They're not taking directional risk. They're not traders in the sense that these day traders are. There we go. So back to the questions. And what's your stance on... Oh, there's one from Ned Flanders, which I almost got to before. If you had to invest 10k right now, where would it be? Short and long term? Any interesting funds? Well, short term, I think there's still further to fall on ARK. So I'd buy SARK. I'd short Cathy Wood's fund. Don't get me wrong, though. I think Cathy Wood's is actually okay. She did reasonably well before the big pandemonium, the kind of pandemania rally after the March sell-off in 2021. She actually did pretty well before that. But then once that happened, obviously the pandemania pushed her stocks to crazy levels. But even before that, she was doing okay. She had outperformed the S&P steadily for a fairly long period of time. So people assume that I don't like Cathie Woods, but that's not true. However, her style of investing has sold off a lot, but I still think it's got further to fall because those valuations are still very high. Interest rates are still increasing. So something like SARK, I think, in this kind of environment would be something I'd go for short term. And I'd be watching that very carefully day to day. But that's not the kind of thing I do really, except for my fund portfolio, which I use to lose money. For long term, global equity, that's what I've got in my portfolio, my core portfolio. Most of my money is in that. So that's how I think you make money. It's having that exposure, ignoring YouTubers, ignoring all the bad news, blah, 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 blah. You just keep putting money into equity for your whole life until you need it when you're an old person, right? That's the way you succeed. That's the secret they don't want to tell you. Okay, next question is from Dinka Chica. What's your stance on precious metals? It actually says previous metals, but I think that's precious. Yeah, precious metals. He corrected himself. So gold at the moment looks undervalued relative to where the dollar is and where interest rates are. So I think, gold is interesting. If we carry on seeing these wobbles in the equity market, I think that could be good for gold. And obviously, interest rates rising is bad for gold. So, if rates carry on increasing a lot, particularly real rates, once you adjust for inflation, that's bad for gold. But I don't think rates are going to carry on increasing a lot because growth is already starting to disappoint. Let me show you what I mean by that. So if I look at something like a GDP nowcast, so this is like a kind of timely GDP forecast based on, oh, right. I think they've suspended it. There we go. Okay. But if you do look at one of these nowcasts, which is still going, the Federal Reserve Bank of Atlanta, I think theirs is still going. Yes, it is. Let's have a look at that. There we go. So what this tells you is as every single indicator comes in which affects GDP, it updates its model forecast for 2021 Q4 in real time. Now, you can see that the blue chip consensus, that's what forecasters, brokers, investment banks are saying, that's been fairly steady at about between 5 and 6% for Q4 2021. But the Atlanta Fed estimate, you can see, was way above that. It was around 8, 9, almost 10% until the end of last year. But notice what's happened since then. All of the data that's been coming through since 3rd of December has been sharply revising that downwards. So instead of almost 10%, it's halved down to about 5%. So just looking at these very rapid, these kind of up to the minute data releases and how they affect GDP, if this model's right, the Atlanta Fed GDP Now model, that suggests that we're going to see disappointing growth. So it won't be like 10%, it'll be more like 5%, and that's already below the blue chip consensus, and it's still heading down. So, what does that tell you? Well, if growth is lower, then generally that means yields will be lower. So instead of seeing higher yields due to higher growth, I think yields would actually be falling, or at least not rising as much as people expect. And people are already pricing in 3 rate hikes, saying that everything's going to be overheating, that inflation's going to stay really high. Well, it's not, I don't think. And so both of those, inflation not being super high for super long and growth disappointing, both of those have a downward pressure on long-term yields. And so I think that actually precious metals, as a result of that, would be in a fairly good place, because if yields aren't high, that's good for precious metals. And if people are scared due to equity market sell-offs, good again, good for precious metals. So, I'm fairly optimistic on gold at the moment. I don't have any, I should say, but not optimistic enough to buy any. But I'm not a big fan of gold. Not in this kind of macro environment, I don't think. I prefer bonds as a hedge. But yeah, there we go. Ooh. Next question. Let's just check the members. Nope. Okay. Next question, we've got 15 minutes, is from Archie's there. Nice to see Archie, my step grandson. Next question's from Apothis6, who I've seen before. Thank you for joining us again. Can you do an educational video about bond yields, interest rates, and these relationships? I feel like most people don't understand the Fed or bonds. In fact, we've got a course about it, so here's my chance to plug our course on bonds. But if you go to pensioncraft.com and look at the courses, the Learning Centre, then you'll see that we have a course on bonds where I talk about all of this stuff, plus what the big bond funds are in the US, in the UK. And of course, there are different types of bonds. You've got credit, corporate bonds, you've got government bonds, you've got inflation-linked bonds. And I explain all of those and what their drivers are. And yeah, I think it's worthwhile doing the course because I explain all of it in a structured way. And it's not very expensive, the course. So have a look at our website, you'll see that. Next question is from Don Calzone, who says, will increasing rates eat up a lot of profits for REITs? Well, of course, REITs are very varied. So if REITs depend on borrowing and on leverage, then increasing rates are clearly not a good story. But as long as the economy stays fairly strong, things like REITs do fairly well. They're very high beta REITs usually. So if the equity market's selling off, risk appetite will be felt even more keenly. The pullback of risk appetite will be felt even more keenly in the REIT market. And usually they're also geographically focused. You'll usually buy a REIT for US commercial property or UK commercial property or UK student housing, that kind of thing. And that's usually linked to the domestic economy. So really a lot is riding on the economy not being crushed by rising interest rates. So there's a lot of provisos. And if equity markets are wobbling, I wouldn't be going into REITs, for example. But would interest rates rising necessarily be bad for REITs? No. They can weather a certain amount of higher interest rates. But it's more to do with risk appetite and growth, I think, whether you get REIT exposure. And personally, I'm not really getting exposure to REITs now. One of the things on my market shopping list is a REIT, but that one is currently too expensive. So I'm not buying it. I'm waiting until there's a risky asset sell-off, and then I'll buy into it probably. But if you look at my market crash shopping list, you'll see what I'm talking about. There's a video I did all about that. Oh, Taher Esfandiari is joined us. Nice to see you. Serenity Coast says, isn't it something like 90% of traders lose 90% of their money in 90 days? Even if it's not true, I just like that phrase. Thank you, Serenity Coast. And Taher agrees with that. Next question. Oh no, Taher says, keep it simple. 2 to 3 funds and a small percentage in high conviction stocks. That sounds pretty sensible to me. Matthew Reed says, let me just check the... Oh, we've got a question from a member who says, yeah, one of our supporters on YouTube. Thank you, Stephen J, for supporting us on YouTube. Remember, you can do that too. Just click on join us and we'll answer your questions first on these sessions. Is DM stimulus going to help long term? Is developed market stimulus going to help long term? A lot of money is wasted in government programs. Government employees try their best not to work, waste money on new equipment, and just stay in their job for the pension. Oh dear, okay. Well, the thing is, if we don't have stimulus like we didn't in 2008 and 2009, you're in a situation where it takes 6 or 7 years for the employment market to recover to where it was before the recession. And you get deeper and longer recessions. So I think it's not just about government employees, which so let's think about the different types of stimulus. If you get fiscal stimulus, the idea at least is that it actually trickles into the entire economy. So let's say we build more highways. So the government issues bonds, they build highways. The companies which benefit from that and their employees will then spend their money in the economy as well. So if you're building a highway, you need concrete, steel, you need workers, you need labor, you need all of the kind of infrastructure that goes with it, all of the trucks, all of the raw materials which go into that. So it feeds through into the entire economy. That's the idea behind this stimulus. So it's not just about people sitting in government offices doing nothing. It's more about the government, which can borrow very cheaply and in huge size, using that power to kind of soften the blow during these economic downturns. That's what it's really about. So I think that's why MMT is interesting, because what it showed us was that what happened in the pandemic was possible, that the government could rustle money out of nowhere. That's their privilege. Has it been hugely inflationary? I think part of the inflation is due to that, but certainly not all of it. It's more to do with behavior of people going back to normal living, which has pushed up prices. So, I think it was the right thing to do to really pull out all the stops for stimulus. And it's not really about wasting money in government programs. It's about infrastructure building, which is a good thing. We all benefit from that. And generally it creates greater growth down the line, spending more on education, that kind of thing, which also stimulates the economy and makes a society which is better, I think, if you have a better educated society. So I think, I wouldn't be so negative on the government wasting money. It's more to do with stimulating people and putting money into people's pockets via the government and its ability to create money. So, I think it was actually a good thing that the stimulus was so big globally. And I think hopefully in future crises, people will remember what happened this time and perhaps repeat what happened this time and shorten the recessions. Because recessions are terrible things. Job insecurity, poverty that comes with it. We don't want to see the Great Depression again. It was a terrible time. And I hope people remember that. Anyway, back to the questions. I've got time for probably about 3 or 4 more questions. Next question is from interesting one. Oh, have I skipped? I think I have skipped down a lot, actually. I'm deliberately working my way from the top of the list because there's got to be some benefit from asking early. Okay. Tim Manchester says C20 is a great idea. So this is a cryptocurrency portfolio token, I suppose you'd call it. But being unregulated and based on the Cayman Islands, what if the company that administers the fund goes bust? Wondering what protections other than crying investors have. A very good point, Tim. Yeah. I mean, that's true of many of the cryptocurrency exchanges, many of the cryptocurrency products. Not having the regulation is actually a problem. It'll change over time as it comes into the kind of normal fold of assets and regulation. But certainly at the moment, that is always a worry. If the exchange gets hacked, you lose all your money. When's the last time that happened on a stock exchange, right? It just doesn't. Joe B says, interesting question. What do you think of Vanguard's new sustainable funds? I assume you mean the ESG funds. Let me just double check that's the case. Just to make sure that I'm talking about the right thing. Sustainability funds. Okay. So I guess this is what you're talking about. these funds. So this is Vanguard UK, of course. So these are ESG funds. So, you know, all the life strategy funds, they've got like new ESG versions, sustainable ESG versions of life strategy, where they vary the amount of equity. And my colleague who does the podcast with me, Michael Pugh, said something funny, which is for his daughter, for her ISA, he bought an ESG global equity fund because he didn't want her to grow up hating him, which I thought was great. And generally I see this, you know, if I have young pension crafters, they're much more into ESG than the older ones, because the older ones are a bit more cynical. They're not so worried about choosing funds which are sustainable. It's certainly not true in all cases. I spoke to a person yesterday who was very much into sustainable investing, and he was in his 70s, I'd say. But generally, that's the case. Do I think it's necessarily a good thing? The trouble with ESG is it's often the case that the fees are higher. It's hard to see that the companies which are ESG or which claim to have high ESG credentials actually benefit as a result of these ESG funds. So if you buy an ESG fund, it may not directly benefit those companies which score highly on ESG. So that's my real issue with it. You know, what are the benefits? Does it really create a sustainable change in corporate behavior? Or is it just a box-ticking exercise for those companies, which, remember that the ESG is most of it is self-reported by the companies involved. And a lot of them will say they're sustainable or kind of good on the environmental, social and governance scores, but whether they are in practice may not be true. So there's always a tendency to lie, you know, if it benefits the company. But I'm not convinced that this is going to change behavior, corporate behavior. I think it's a step in the right direction. But if I was going to invest in this way, I'd much prefer to go for something like an impact fund, where there are very clear performance indicators. It's a very concentrated portfolio with very clear sustainability goals. So you know, for every pound you invest in this fund, this number of units of carbon were not emitted into the atmosphere. So I think that's a much better way to invest in an impact fund rather than ESG. But, you know, is it a bad thing? No. You know, I like to see it, and I'm just a little bit skeptical as to how much it's going to change behavior or benefit the environment in practice. But it's nice to see Vanguard doing that, you know. Well, actually, there is another thing which kind of interested me. I spoke to a chap who gets funding via private equity, who said that they increase your multiple when they value your company if you claim to have ESG credentials. So clearly, it does have some effect for companies raising capital, and private equity is starting to be sensitive to this. So maybe it does have an effect. You know, maybe I'm being too cynical. No, so one last question, I think. Any from members? Oh, here we go. So the last question is from Gary, who's one of our supporters. Thank you, Gary. Who says, do you see a possibility that the Fed is right about their transitory theory, but is wrong about the duration of transitory? Then this rapidly going hawkish may prove to be a policy mistake in future. Oh, interesting. I like that. I mean, certainly by my calculations, it'll take, even if all of the trend components, even if all of the components of CPI in the US went to their long-term trend growth rates today, it would still take 7 months for inflation to come down to 4%. That's still double the Fed's target. So that's why I think it may be around for some time, even if things normalise today, which they won't. So I think the duration of transitory is something they haven't really talked about much. But if we look at the dot plots, we should be able to see actually let's have a look at the projections. So is this September? Yeah, we should actually be looking at December. I'll share my screen in just 1 second. I'm just trying to find the summary of economic projections for the most recent statement. See if we can find the dot plots here. And if I can't find it, I'll just give up. Yeah, I can't find it, of course. But yeah, I think the Fed hasn't been that clear as to when inflation is going to come down. So they've been hedging their bets, saying they're just going to watch the data. 2022, at some point, I think they've said that inflation is going to come down. And remember that the summary of economic projections is not a forecast. It's just like an informal publication of where the participants in the FOMC committee expect inflation will be. So, you know, I just don't think that it's going to stay this high forever, because a lot of it is behavior based. Things like supply bottlenecks will be eased at some point, because we've already seen chip manufacturers increase supply, and that takes a while, because to create more chips you have to have a lot of infrastructure in place, but the kind of plans for that are already in place. So, you know, the supply bottlenecks will ease because the supply will increase eventually, and our behavior will change as well. We've already seen the savings rates, which were at incredibly high levels, fall back to normal in the US, in the UK. So that extra money that's washing around will diminish quite soon. So, you know, gasoline prices won't keep on going up at these rates that we're seeing now, and you know, a lot of the base effects which are causing that will ease and probably go into reverse, and if anything, that's going to start pushing down inflation and pull the other way. So unless we see a price wage spiral, which is not happening yet, then, you know, I expect to see inflation coming down 7 months from now. It should be down to about 4%. But has the Fed got it wrong? They never actually came up with a forecast notice, so you can't really say they got it wrong. Were they too late to hike? Well, remember they're still buying, right? So they're still buying assets at an incredible rate. Even though they're slowing it down, they're tapering. They're still purchasing at about $100 billion worth a month. So, you know, we'll probably have to wait until that kind of ebbs a bit before the hikes start, and that's going to start in March probably. But have they got it wrong? And was their forecast wrong? They're a bit cagey about it, right? So we'll never really know. But anyway, look, I still feel fairly confident that markets won't be too bad in 2022. But we'll just have to wait and see what happens with policy and whether earnings kind of hold up. But I suspect that things won't be too bad. At least that's what I'm hoping. So all of you have a great 2 weeks until we see you again. And thank you for joining us. We really appreciate the fact you spent an hour with us, if you did. So thank you very much from Teddy and I. Listen to our podcast, which is now available. Many happy returns. You'll find it on your mobile devices. And we'll see you in 2 weeks' time. So have a great 2 weeks, everyone. And good luck with your portfolio.